Again, we thank you for coming today. I'd like to get started and kick it off by introducing our first keynote, Dr. Jim Duncan, Director of Commodity Market Research at ConocoPhillips. Dr. Duncan spent his first 15 years as an engineer, manager in process design and process troubleshooting, where he designed and built patented petrochemical processes before returning to teaching as an assistant professor of chemistry. Today, James is responsible for developing customized financial market strategies for both ConocoPhillips and its customers. He holds a BS in chemistry and a PhD in chemistry and chemical engineering. With that, I'd like to introduce Dr. Duncan. Jim?
Well, good morning. Okay, you're gonna have to wake up because otherwise we'll leave you. Interesting dynamic. If we were standing here last year, we would have been staring at a market that was poised, or at least holding its breath, trying to figure out where it would next go. This time last year, crude oil was, basis WTI was somewhere in the 90, sliding to $85 a barrel mark. Hadn't really fallen off a cliff yet, and we hadn't even started talking about cliffs. If you looked at everybody's 5-year outlook this time last year, it still had the hockey stick graphs going up, and we were all expectant that this short-term phenomenon, which was sliding off of a WTI price at $105, was going to be just that, short-term. When in fact, we were staring down the barrel of something that we'd already seen in other markets. Because after all, that's what we're supposed to do, is figure out what a market is doing, or more importantly, figure out what a market is going to do. I would just about do anything and get any data set and use any mechanics Genscape would produce for me if I could come up with something that would be probabilistically accurate in telling me what's going to happen next. But yet that's where we've been in the last year. The biggest change in the oil industry and the energy space has been just this last year, and it's probably going to continue to do that as we go into 2016. And the questions that arise out of this is what I hear from my customers across the country. They all follow similar themes. And I talk to producers and end users, and we get down and dirty. Because when it comes right down to it, if you don't call it right, they tend to get upset. The role of an analyst or a researcher is to figure out where things are going to go and how things are changing. I use a lot of the really fun mathematical pieces of my brain to do some of this work. The other half of it comes from the music side, where I spent the other half of my ill-gotten youth designing music. Because part of it's art, part of it's science. And we talk about a constrained system because that's usually where I start. A constrained system, a system that finds itself limited somehow, either artificially or by design, in any circumstance, will have a volatile outcome. Sometimes that volatile outcome is in a nitrate-based chemistry reaction, which is very explosive. And sometimes that same type of constraint turns into price volatility, if not explosion. And we're going to talk about the character of the market, the picture of the market as basically I see it now, and then hopefully we share all that. We get with each other and say, okay, I don't agree with you here, I do agree with you there. But that's what a forum is about, is to get together and talk. It's in the rocks. The character of the oil business has changed, or the energy space especially, on several fronts. To design a system, you need you can divide it into two basic areas, kinematic and dynamic. And of course, now I'm going to lean back towards lecturing, so just don't fall asleep. I know it's 8 o'clock in the morning, just don't fall asleep. Kinematic is the definition of where a system is. Dynamic is usually where a system is going through a change, trying to get to a different state. That's as much as I'm going to go. But at any given time t, we look at a system and say, we want to define where it is. And the majority of the stuff I see in the world is defining the system as it is, as it clearly is to whoever's doing the analysis. But the dynamic part usually escapes us. It's also the most dangerous part, because whether or not your sign in your math is positive or negative will tell you which direction price moves. Because price, after all, is the ultimate look. So what has changed? What does our market look like? The biggest change over the last year has been crude oil. I already said that. How do you turn this? There we go. I may have a viewpoint. Read this. I was a professor. I am legally able to give you tests. Biggest story of the last 365 days is crude oil. It's almost like it was a surprise. Some of us stood around and said, well, you know, we watched natural gas go from a high of $14 MMBTU in 2008, and then we saw this new form of productive capacity and the excitement that was the new formations of shale. And then we watched supplies increase, and the dynamic change in that market moved towards kinematic, which was very quiet indeed. But crude oil hadn't done that yet. Liquids hadn't done that yet. And the trigger, which it always has, which is another small mathematical piece of reality, the new study of avalanche theory. If you haven't looked at it, it's fascinating. There's probably about 6 guys in the world, or people in the world, who know what avalanche theory is, but it's going around. It's that which snowflake causes the avalanche. And when you think about it philosophically, well, anytime you think about something philosophically, it can turn into a PhD, because that, by definition, is a PhD, Doctor of Philosophy. So it's a philosophical question because we couldn't actually identify it. We just know there is one. But there was an avalanche in crude oil. And we ended up with a very, very oversupplied market. The reality is global oil production had continued to increase. The biggest mover in that, of course, had to be domestic U.S. production. To the point that we were, last year at this time, 94 million barrels a day, roughly, of supply globally, where we had 93 million barrels a day of demand. It didn't take much math to figure out what that was going to look like when we got all said and done. But yet, forecasts still show us continuing to move. Top 5 global producers are still pretty much the top 5, but look at the U.S. The U.S. has the first true hockey stick graph I've seen, even though I've seen forecasted hockey stick graphs forever, where it just goes along and then it shoots straight up. But that is in the rocks. The rocks are different. You see, the biggest difference between shale and where we have been traditional production is traditional production, the drillers, the producers have gone out looking in the fields for these reservoirs of hydrocarbons, and those hydrocarbons are in pools. And they typically are, in general, in certain areas that we know of, and we identify, and we can put several wells into that. And the wells may or may not be owned by the same operating company. And when and how we produce those hydrocarbons will dictate the supply that comes on the market, but it also dictates the supply that is available to the operator. Now the question becomes, who can afford? What are the prices? What's the cost to produce the well? What's the net return investment? Because that's what producers are always looking at. And it's the same with any system that we talk about. It's called return on investment, ROI, and it's become more and more important, and you can apply that same math, these same models across any number of industries, which we've done, because that's what you have to do if you're looking for a dynamic system or a kinematic system, because kinematic systems are quieter, less volatile. Dynamic systems can surprise you, like natural gas and crude oil, and even gasoline and diesel has done the last year. But the response was pretty straight, and all the talk was about what the recovery of crude oil was going to look like. Is it going to be a V recovery? Is it a W? And those people that knew what the heck that was were very vocal. Well, I think it's a Willy Wonka letter right now. I'll let you think about that. Point being is we have probably responded faster in this market than I've ever seen. 95.7 million barrels a day we were producing at last check, chasing 96. Production has actually increased since prices have gone down. A number of reasons for that too. But I'm looking for my dynamic response from the market. I've seen it. Crude oil's been down dramatically. And now the energy industry is responding in kind by slowing down and contracting. Have plenty of supply. At the rocks, it's different. Those reservoirs that we used to produce out of, we've always known that there were hydrocarbons in the rocks. We didn't have a way to get it out. I was told by geologists 30 years ago, oh, we got more oil in the rocks than probably a lot of the producers in the world. And I said, well, why don't we go get it? We don't know how. But I know it's there. I know where it is. We just don't know how. And then the technology showed up, and we've produced that. The difference is we don't have reservoirs as total part of our pools. We have rocks, which means I can come back next year, 5 years, 10 years, 20 years from now, and the hydrocarbons will still be there. And that makes it an economic question. It pushes it over into the kinematic, economic, stable state of binary decisions. Is it return on investment or is it not? And what are my outlets? Because I've got to be able to use this stuff. If I don't use it, then the dynamics will change. In natural gas, it's the same thing. Most of the people I talk to are looking for a production change. And of course, we live in very narrow bandwidths in natural gas. We're expecting to fill storage. We still talk about the same things every year. You think we're going to get full in storage? Well, what's full in a compressed commodity? These are some of the questions I can't answer. I can't actually say to the people that ask me, please feel free to ask any question. But the science part of me goes, a compressed commodity. We can probably stuff molecules in as long as the sides of the container don't move. Or maybe we could liquefy it. Because that's a question too, whether or not we're going to have an outlet for LNG. And we find ourselves 180 degrees in phase in that market as well. We started with regas facilities that were 54 in number early last decade, and now we've got a similar number of facilities that are planned, majority not started, but yet to an export. This market screams of globalization, the word that we only hinted at early last decade. And here we are pushing 4 trillion cubic feet in storage. And we say we're full and we've got more than enough supply. And we've set new records this year for natural gas production as well, even in a low price environment. And a lot of questions from my customers are the same thing. How can we keep producing more natural gas when prices are down? And the answer is simple. We get gas out of every hydrocarbon well we drill. It's called associated gas. The majority of gas that we produce now is out of associated gas, gas that comes with hydrocarbons. And it's important to know that because if we stopped drilling for any of it, we would start losing that oversupply of 82, 83 BCF a day, numbers that we never thought, so those of us that have been in that industry for a while, we'd get. But the capacity's there. The question is this now a dynamic system that's moving away from that state yet? Because we know at some point this market will do a reversal. Because if you don't have return on investment, over the last several months, costs have started to come down in the field, and we expect that to continue. And we'll get lots of pictures of that as we go forward. Delivery capability for natural gas is going up. Pipeline plans are still out on the books. We've seen, I've got 7 or 8 that are going to Mexico now, just Mexico. And that's an export. Northeast, pipelines, Atlantic Sunrise, taking gas out of the Marcellus, probably the only formation that's grown throughout this low price environment because it's in the marketplace. Because the seasonality in natural gas now is very contingent upon a winter that we now don't know whether we'll have or not. But we've got a storage number that's 4 TCF, and that 3.9 last time we got here, we saw constraints in the system, some serious constraints in the system. In the last 3 winters, we've seen constraints in the system as it's come out, which has caused volatility to move, volatility in price move from where it's traditionally been. And that being the CME, the NYMEX contract, whichever you want to call it. And the cash contracts are more volatile now. A change, a significant change in this marketplace. So natural gas is still trying to figure out. Canadian imports are down, you'd expect that. The impacts, since we have more supply, you're pushing against supplies you don't need. Mexican exports are up, expecting to be a much larger number. We're pushing over 3 BCF a day of exports. Just 2 years ago, it was 1 BCF a day. And Mexico was saying that they were going to grow to 3 to 5 BCF within the next 5 years, which meant that exports were already occurring, at least through the pipeline. Construction continues to go in the areas of transport. Return on investment is advantaged and risk on for transport. Supplies we know. Demand is a question, because overall demand has increased. And primary for that is the availability of supply. With pipeline changes, we expect to see flows change from their dynamic shifts, both in the crude market and in the natural gas market, especially the natural gas market. We own the most advanced, complete transport system for natural gas over any country in the world, and yet we're still not done. There are times in the marketplace where natural gas supplies, even though it's oversupplied, it's tough to get, not impossible. We have yet to see a winter where, even in the coldest winter, I love the picture of Chicago with ice drooping over the walls. I love it because I wasn't there. Okay, you know exactly what I'm talking about. I endeavor to spend my life south of Interstate 10, those of you that know me. We are now south of Interstate 10. So I'm very comfortable right now because it's warmer south of Interstate 10. But I do have sorties that take me north of Interstate 10. That winter was met by a volley of natural gas. Since then, we've started seeing major shifts in power. The most active segment for natural gas right now is power. And 2015 is going to go down in the books as the largest shift away from traditional generation that we've seen. If you look at Genscape's numbers, just in the last year, we've seen a massive shift in capacity for generating electrons in the power grid away from hydrocarbons and more towards renewables. Much larger than anybody expected in those forecasts for hockey stick graphs. 9+ gigawatts of renewable capacity just in the last year of wind and solar has changed the electric market dramatically. I've been marveling at how it's shifted and how the power industry has responded just in kind to be able to manage that kind of load. And they're now coming up with a menagerie of terms. You know, it was the duck curve. I heard that 3 years ago from one of my utilities. They said it's the duck curve. Really? What's a duck? I said, it quacks, has this little bill. I said, very funny. What's a duck curve? And they showed me that it's very difficult to meet midday loads if you're having to shift from traditional generation to renewable generation. And now they've come up with the rhino, let's see, I've already forgotten the load. The alligator, and it doesn't matter. The alligator graph is coming out, and they told me the rhinoceros, and I don't believe them because I didn't see the rhinoceros graph. I saw the rhinoceros graph, I just didn't see the rhinoceros that was in there. I saw the alligator graph, but we've got all these graphs and terms for the analysis for a dynamic system that is going to be inherently different when we get there. But that's the biggest shift, and that's what this transport has meant, where supply is shifting from our traditional basins, and the prices in those basins have reflected that. We've seen extreme volatility in the Northeast. Just in the last month, you'll see numbers from Genscape that have dropped 58 cents an MMBTU in the cash market. And it could just as easily flip around, we know in short-term history, and jump up if there's a cold winter. Question is if there is. From a global perspective, the demand for LNG right now is very brisk. The outlet for those supplies, that excess supply that natural gas is producing right now is quite obvious. And there are segments of this market that are moving that direction fast. As I said, the regas numbers have turned into liquefaction numbers. The question is, what kind of market do we see when we get out there? Because the world, at some point, will recognize shale. Some estimates say there's 16,000 trillion cubic feet of natural gas available in the rest of the world. And that's not all the rest of the world. My geologists tell me that there's some areas we haven't been yet. Natural gas is turning into one of the. That was it. I just got to speak at a coal conference in May. No, I saw some of the saddest faces I think I've seen in a while. And I wondered why they wanted to invite me to speak. There's an industry there that still exists, and it's going to be interesting to see how it morphs and changes itself, because there's still a lot of coal available from an energy perspective. We are an energy-hungry society. It's not going to get better. But there's 111 gigawatts of oil, natural gas, coal, and nuclear retirements between 2010 and 2020. The question is when is it? And there's a whole stack of states that are going to be impacted. The new generation and where it sits will change how we look and what kind of fuel stack that we need going forward, because electrons are not really given up that much. And then the next question ultimately is, what kind of winter do we have? We hear about things like the Polar Vortex. I've had nothing but fun about the Polar Vortex, I just want you to know. You've heard my background. I am not a meteorologist. I play one every day. Okay, you'll wake up onto that in a minute. I play one every day because all of us do, especially if you're in your market. The most strategically dynamic push in markets of energy are associated with weather, and weather is the one area that we haven't quite gotten yet. We've been forecasting an El Nino winter for the last 4 winters, and we're in the 4th winter of that. The last 3 have turned in exactly opposite, at least in name. And those that were planning on a winter that did not have significant demand were pretty much surprised 2 winters ago when that demand hit 50-year highs in some cities across the east of the United States. And that is when we hit dynamic systems where degrees of freedom disappeared. Degrees of freedom, those are variables, those are outlets of where our ability to take supply or any supply type dynamic variable is that we can move to somewhere else and balance a system. We've seen that constrained systems end up with very few degrees of freedom. And since natural gas is a closed system and it cannot get outside the borders of the United States, that is a dynamic closed system that is very succinctly tied to what kind of weather we're going to have. And we're heading into another weather period. And the classic El Nino says that it's warmer in the north and cooler in the south, and that's exactly opposite of what you'd want to see. If you were a producer, it's probably exactly what you want to see if you're trying to be an end user. And I have to make sure I have which hat I'm wearing that particular day. Because a quiet system, natural gas since January this year, the contract put out by the CME has moved in a very narrow 50-cent range, a very quiet 50-cent range. It doesn't move 50 cents at all. The volatility associated with this market is nil. It's crickets. And you can talk to my traders and you'll know that. So, what does that look? And we're back to finally, where are we and what does that look like? The problem with this winter is that we are keenly aware that there's cold air somewhere. And most likely we've not done a good job in 7 of the last 10 winters of predicting whether or not winter was going to disappear. So we are at least on a risk-on probability. From a crude oil perspective, we have a market that has lost 60% of its value from 365 days ago, and you've got a market that is rife with all sorts of predictive math associated with where we're going to be 365 days or even by the end of this year. And the reality is we still remain massively oversupplied in all of the hydrocarbon markets. We haven't got a lot of wiggle room. There's not a lot of degrees of freedom. We are pretty much in a kinematic system that is quiet. And we will be that way for a while, or at least until we are forced through degrees of freedom into another dynamic shift. Where that goes next will dictate how we respond. Industrial demand is going to increase. I've got the list of customers at my desk that are asking for new natural gas supplies out 5, 10 years. But it is the next 5, 10 years that we're talking about. So the reality is we come up into the fall session, we come into a winter out of a quiet summer that is really going to be triggered based upon 2 things. One is what happens in the crude market, because a very quiet crude market, remember the natural gas piece? The supplies of natural gas are coming from the exuberant drilling of crude oil and liquids wells. The return on investment, if that does not occur, it will slow down that effort. And of course, the break in upward supply will occur. And the response to that will be pretty much automatic. But that's not here yet. The same thing happens with natural gas. We've been bought out by winter, if you will. Maybe not bought out, but more than likely saved from a massive gridlock in natural gas supply, of putting in that last molecule into that container and maybe actually achieving the full designation for natural gas. We will be full in supply. The question is what the demand looks like. So as we settle into this conference, there's several questions that we need to ask. And they're the same questions that my customers are asking. What does a low interest rate, low fuel, low activity market look like a year from now? where would you put your investable dollars? In the United States, there's 18 trillion investable dollars that needs return on investment. Where would you put that money? And would you put it in the energy business? Second, there's 47 trillion investable dollars roughly in the world. Where is that money going to be invested? Where are my risk-on places to worry about? And what are the strategies I need to employ that manage that risk? Because we have instituted and are in a position of managing those risks more now than we've ever been able to do. The question is whether or not we're going to actually make those decisions. And ultimately, they want to know which way the stock market's going to go. I don't know why I get that everywhere I go. Which way is the stock market going to go? So that's a totally different off-subject question. There's a lot of other things that they ask, but about transportation and which LNG terminal is going to happen and what Mexico is going to do and what Canada is going to do and ultimately what Europe is and what China really looks like. Is China dynamic or are they kinematic? And they don't know they're asking that, but that's what it translates into a chemist's mind. So the question is, as we go into this, which way do these markets turn and what strategies do we employ? And ultimately, what data tells us, which data set do I buy and what mathematics do I employ to tell me those signposts? You see, we're in a totally different market there too. 20 years ago, when we were trying to figure out markets, we had very little data. We had very little supply of information. And we would beg, borrow, whatever we could come up with to share the information. We didn't have that many ways to share information. When I was doing pure research, I had to send, okay, I'm going to tell you how old I am, tapes, computer tapes in the mail. That was file transfer protocol then. It's called mail, and it didn't have FedEx. And they would run their tapes. And I was so thrilled when we got a 300 baud modem. I could sit there and get a file in 2 days. It was great. Now we have massive supplies of information, and we try to figure out which is good and which is not so useful. And that's pretty much what we're going to see here. So I'm going to be around talking questions. Do we want questions?
Yeah.
Absolutely. Yeah. Oh, I have a lot of opinions and viewpoints. You know me better than that. Yeah. Do what?
About borrowing base, about what the investment community will say.
Well, we're in restatement.
Right.
I'll assume everybody knows what restatement is. Restatement's going to it will dictate the amount of money going to certain groups to expand or continue their operation. We won't know what that picture looks like until the end of the year, probably even from fourth quarter perspective. But it's a pretty good idea that it shrinks. I try to track the publicly traded exploration production companies. There's 384, I think, on my list. And I rank them according to credit default, and I've got a formula that I put in net present value of cash and revenue versus debt. It's only one side of my brain understands it. And the reality is there's 277 what I would consider on the bubble. That doesn't mean they're going to fail. That doesn't mean anything other than they've got a cloud. So that's a pretty big ratio of publicly traded companies. It doesn't cover all the companies. So that tells you, if nothing else, on a very basic level, from an exploration production company, the people that are actually going to drill, it's going to center around those that with the healthiest balance sheets, and those are the ones you're going to want to invest in. Obviously, we're one of them because we are going to be around, but there is going to be considerable shrinkage Shrinkage is probably the key word because we already know that if supplies start breaking, my investing community is looking for a break of that uptrend in supply to try to figure out where the market's going to go next. What you see is not a firm break. I don't see that in my math. What I see is a sinusoidal curve of oversupply, undersupply, oversupply, undersupply, till we get a managed hold on what we produce and what demand, especially with demand increasing. So yeah, I've got there's more numbers behind that, and I'll be happy to share that with you. Yes, sir.
Since the last 12 months, what's Conoco's position on the Gulf of Mexico in light of all these changes?
ConocoPhillips, we participated in the last lease dynamics, but everybody's in the kind of wait and see period. There's still a lot of opportunities in the world as a whole. We haven't really changed that much. From a natural gas perspective, Gulf of Mexico has continually declined, but Gulf of Mexico has been primarily a crude oil anyway, especially after things like Macondo. And I think as we go forward, there's still a lot of opportunity, bright spots out in the Gulf of Mexico. The question is what they cost, what the return on investment is. Everybody's in a review period. We're all taking ourselves into restatement. Yes, sir.
You were talking about your customer base in industrials. Could you elaborate a little bit on what you're seeing from a demand growth perspective?
The question is, what's the demand growth in the industrials, the customers I'm seeing? That's probably, next to the electric groups, that's my most interesting group to talk to, because the list of new plants trying to take advantage of the natural gas price in North America has grown considerably over the last 3 years, if not 4. We're already seeing plants that are being put in, and where they're being put in, the types of plants that are going in. They range from precursor dynamics, which would be like methanol production, to automobiles, cars, trucks, toys, plastics, crackers. It's a whole gamut to take advantage of this low-priced fuel environment, because the rest of the world is not seeing it, which is similar but opposite to what we saw in early 2000, where natural gas prices in the United States went up and we saw a lot of movement exporting of plants, and now, especially fertilizer plants. I think at $5 we lost 50% of the fertilizer plants in North America, and then they flipped around. We've got plants coming back in all sectors, not just fertilizer, just to take advantage of the natural gas. Big list. I like that. Yes?
Just following up on that question, you guys tried to quantify the incremental impact from that industrial development?
We do. Yeah, we do. We're in the middle of a rather giant study of trying to capture that, and I wish I could say what. When I do get to that number, I will be sharing that, but I can't. I don't know what that number is. But we are at the tracking and putting down on Gantt charts. You know, when things come on, what they hit, what they're. I'm sitting down and going through the reaction dynamics and doing molecular balancing equations and stuff I didn't think I was going to have to do again. And trying to figure out, okay, how much natural gas would that translate into? And is it significant? Because it's always the marginal molecule that prices out. And it's even more important to realize that where the plant is important now. Is it even more so important now because we're seeing natural gas respond regionally and very quiet in other areas. So it's going to be an interesting study when I get done, because that will be the marginal molecule, not withstanding the electricity. Yes, sir.
If we see continued oil prices in the low $40 for the next 6 months, 6 to 9 months or so, do you have any estimate of the extent to which that would result in further reductions in drilling and completions, and how that would affect associated gas production?
Okay. What's my kinematic where I'm sitting right now, and restate my question for me. What do I see in the next 12 months impacting natural gas based on the drop-off in drilling? Is that what we're saying?
Well, personally, I think we might see some fairly sharp cutbacks, further cutbacks in drilling and completions. I'm sure you focused on that, and I guess first part of my question is, if in fact we get prices, let's say around $40 for the next 6 to 9 months, do you have any estimate of the further reduction in drilling and completions that would result from that? And then secondly, focusing time back to your points about associated gas earlier and how important that is for the gas market, what reduction in natural gas production of associated gas do we expect?
Good question. The infield drilling, the infield upgrading of drilling that's going on and has been going on hasn't quite finished yet. Most of the companies are trying to adjust and equilibrate which fields are our best return on investment or for what capital we have. How that impacts at a given price point, I got asked that in February. It was in a room of oil energy experts, or not experts, CEOs and type. And they said, where do you think the price is going to be? And if you're anywhere near Houston, you know about Mattress Mac and his claim, if you can buy furniture for free, if, you know, because crude oil doesn't hit $80 by November. And that was the basis of the question. Where do you think it's going to be? And I didn't give him an answer. And because it's not a simple answer. $40 for one producer may not be the same for $40 for another producer. It's well dynamics, ownership, et cetera. So you can't, the math hasn't worked yet to figure out which price causes how much volume to come on or off. All we did see is we've seen some flags where crude oil, WTI, moved back up into the mid-60s, and we saw some hedging. Hedging throws that off. Okay, who's got hedging? How long did they hedge? And so we're not quite sure. We're in the early stages of figuring out what this sine wave is, which is amplitude, frequency, and how fast this thing responds to itself. And so far, it's been rather slow. 30% is the typical associated gas on a traditional supply deck that we've seen out history. The problem is that number hasn't worked. If you get into areas where we don't have a mature gathering system, for instance, the Bakken, you don't end up with gas that's net added to the system. And that's even changing over the time. So we are looking at the increase in consumption as the opportunity for infrastructure to move. And that's what's making this thing dynamic. I have some personal guesses, but we'll talk about that offline.
Okay, thank you. I think we're going to move.
Good.
Thank you, Jim. Excellent presentation. And let's give it up for Jim. Good job.